A Canadian investing $500 a month for 10 years should watch it grow to about $77,000, but she'll never see roughly $11,000 of that. A 2% management expense ratio silently skims it before her statement is ever printed. This isn't a bill she pays, it's growth that simply never shows up. I read the fine print so you don't have to. Millions of Canadians pay this fee without ever seeing a charge on a statement, and over a full career, a 2% MER can erase roughly a third of your final portfolio. So we're going to do 3 things. Audit what you're paying, model the 25-year cost, and reallocate to low-cost funds. The typical MER on a Canadian equity mutual fund is about 2%, and according to Morningstar and Calm Money analysis, that can erase roughly 1/3 of your final portfolio over a multi-decade career. But here's the part nobody tells you. It isn't a fee you pay. It's returns that never compound. That's what makes it so easy to ignore. 3 moves fix this. Audit every MER you're paying, model your 25-year fee drag, then reallocate to low-cost ETFs. Each takes under 30 minutes and costs nothing. The first quiet cost is the management expense ratio, the MER, charged on your Canadian mutual funds. According to fee analyses of Canadian funds, the average equity mutual fund charges an MER of about 2.2%. Here's the trick. It's taken out of the fund's assets daily and reported as one annual percentage, so it reduces your return every single year before you ever see it. There's no invoice, no line item, just a number on a statement that's already smaller than it should be. Now watch what that fee does to your return. A fund earning 7% gross with a 2% MER delivers only about 5% net to you, according to Trailfolio and Calm Money analysis. On a low-cost ETF at 0.3%, you'd keep about 6.7% instead. That 2 percentage point gap doesn't just cost you 2%. Because the fee is charged every year, it compounds against you the same way returns compound for you. The second layer of damage is how that lower rate erases whole years of growth. Most of your portfolio's final value comes from returns on returns, not your original contributions according to Canadian growth calculators. So shaving the rate quietly deletes the compounding on top. When a 7% market becomes a 5% net return, you don't just lose 2%, you lose years of momentum. And it bites hardest in the first decade, when your balance is small and compounding is only just building. Here's what that looks like in dollars. Suppose you invest $500 a month for 10 years in a fund tracking a 7% market. At 0.3% MER, that decade grows to around $77,000 according to Trailfolio and Money Metrics calculators. At 2% MER, the exact same contributions reach only about $66,000. That roughly $11,000 difference isn't fees. It's compounded growth that never existed because the rate was clipped every year. The myth is that 2% is a small fee, and good managers will just make it back with higher returns. The fact: Canadian fee analyses show 2% plus MERs are large enough to reduce your final portfolio by a third or more over 30 years. And there's no consistent evidence high-fee funds beat index ETFs after fees. Put both costs side by side. On a $300,000 portfolio, a current 2.2% MER costs about $6,600 a year versus $900 at 0.3%, a $5,700 gap every year according to Calm Money. Scaled over a career for a mid-career saver, that compounds toward roughly $180,000 of erased wealth, with no change in contributions or risk. Meet Sarah. She's 38, a mid-level manager earning $95,000 with $250,000 invested across her RRSP and TFSA, mostly in Canadian bank mutual funds. She contributes $1,200 a month and wants to retire in 25 years. Here's what Sarah found when she finally read her fund documents. Discovery 1, $5,500 a year. That's what Sarah's funds cost her, a 2.2% MER on her $250,000 balance according to the Calm Money case study. She'd been told her fees were just small percentages. But a low-cost ETF at 0.3% would cost her $750 a year. She's paying over 7 times more, and that $4,700 gap compounds for decades. Discovery 2 hit harder. She's on track to lose roughly $180,000 to fees by 63. Scaling the Calm Money Ontario case study to her balance nursates, switching from DURL's 2.2% to 0.3% MER with no change to contributions or risk. could add about $160,000 to $180,000 to her retirement. That's several years of retirement income, decided entirely by a fee. Discovery 3 was the one that stung most. Her first decade was already clipped. Investing around $800 a month for roughly 10 years, her RRSP contributions could have grown to about $77,000 in a low-cost ETF, according to Trailfolio and Money Metrics. In her 2% funds, they're closer to $66,000, about $11,000 already gone. And that gap is set to snowball over the next 25 years as compounding amplifies it. Add it all together, and Sarah's lifetime fee gap lands around $180,000. Modeled on a $250,000 start, $1,200 a month, and a 7% gross return, scaled from the Calm Money Ontario case study. Same contribution, same market risk. The entire difference is the fee she never noticed she was paying. So could this be you? You've never looked up the MER on your funds. You don't actually know whether you own mutual funds or ETFs, or you bought your investments through a bank branch advisor. If any of those sound familiar, the next 3 moves are exactly what you need. These 3 moves work because they attack the fee at its source instead of chasing better returns. And lower fees are the one thing you fully control. First, you'll audit exactly what you're paying, then model what it costs you over 25 years, and finally reallocate into low-cost funds. Together, they can move 6 figures back into your own retirement. Move 1. Audit every MER you're paying. This matters because you can't fix a cost you can't see, and the fee is deliberately buried in a document most people never open. Log into your bank or brokerage, list every mutual fund and ETF across your RRSP, TFSA, and non-registered accounts, then look up each fund's MER in its fund facts document. Multiply your balance by the MER to see the real dollar cost. Here's how. Export your full holdings list from your bank or brokerage, then look up each fund's fund facts and note the MER percentage. Finally, calculate annual fee as balance times MER for each one. Good looks like broad index ETFs at 0.10 to 0.30%. Anything above 1% is well over the benchmark. Move 2. Model your 25-year fee drag, so the abstract percentage becomes a real dollar figure you can't unsee. Use a Canadian investment growth calculator like Trailfolio and run 2 scenarios. Your current 2% MER versus a 0.3% ETF, both at 7% gross. This is general information, not personal advice, and those tools are illustrative. The dollar gap is often in the hundreds of thousands. Here's how. Enter your balance, monthly contribution, and a 7% gross return, then run scenario A at 2.2% MER, around 5% net. Then run scenario B at 0.20 to a 0.30%, around darts 6.7% net, and note the gap. Good looks like this. If the difference tops $100,000 over your career, that's a serious actionable opportunity. Before I get to the last move, which is the most counterintuitive part of all this because it's the only one that actually stops the bleeding, here's why it works. Move 3 is to reallocate inside your RRSP and TFSA to low MER ETFs. Sell the high-fee mutual funds and buy equivalent risk index ETFs, Canadian, US, and global equity, at 0.10 to 0.30%. Do it inside your registered account so you don't trigger a taxable disposal. Here's how. Identify your highest MER funds, those above about 1%, and their balances. Pick same risk index ETFs at 0.10 to 0.30%, then sell and buy inside the registered account and redirect your future contributions. Good looks like a weighted average MER under 0.5%. If breakdowns like this are useful, subscribe. The next one's already coming. And the rules are firmly on your side now. In 2016, CRM2 forced firms to show your fees in dollars, not just percentages. In 2022, deferred sales charges, the penalties for leaving a fund early, were banned across Canada. And in 2025, total cost reporting requires statements to show the fund fees you pay each year. Every one of these changes makes fees easier to see, which means it has never been simpler to act on them. Once you've acted, verify it worked. You should see a weighted average MER under 0.5% across your accounts. Confirm your new ETF trades actually settled inside the RRSP or TFSA. And if your automatic contributions are still buying the old funds, redirect them today. Everything here is drawn from Trailfolio's growth calculator, the Calm Money Ontario fee study, and Money Metrics' ETF comparison. All the links are in the description if you want to run your own numbers. So today, You learned how a 2% MER quietly erases a decade of growth and the 3 moves to stop it. Next, I'm covering the deferred sales charge, the exit penalty that could trap your money in a fund for 7 years. It's one of the sneakiest clauses still lurking in older Canadian portfolios, and most people don't know it applies to them. If you want to catch that one, subscribe now so you don't miss it.